I'm going to talk to you about how exactly to make money on puts. Exactly what you're tapping on your phone. So here's my phone, and today we bought puts and realized puts. I'll just show you. This is the chart of the actual put. Right here at 79 cents, that's when I entered. And by the end of the close today, it was over $2. And so if you can see, at the time I took the screenshot, it was $1.81, and I was long 10. I actually was long 20 from the beginning. So I was long 20 puts. I bought them at 79 cents. Got filled right here. I put a stop loss at 80 once it got, closer to $1. And I sold half of my position at 1.81. And so this realized about 1,000 of the $2,000, and I still had another $1,000 that was just sitting around, holding on as the value of the put fluctuates. So let's talk about exactly how this works. So here I have my home screen. I'm going to tap the interactive brokers, my brokerage app right here, this one, and I will initiate it. And once I already have my fingerprint enabled, but basically you get to this screen and you have these options here. But on this watch list screen, this one on the top left, this one right here, if you go there, then you'll end up on this add contract. And what you can do is you click on the add contract and you end up here. You type in SPY for the S&P 500, right? And then you click search. So once you search for that, then you click this option chain and strategy builder. You can also do the options itself, but this one gives you a bigger kind of like visual feel of what's going on. So here I'll make this a little bit bigger so you can see. Alright, so here this is what we have. This is called the option chain. So here at the top you have the different expirations. This is the nearest one. This is the 1 week afterwards, and then the week after that, and the week. So every week there's a different set of expirations. I can change it to December 24th, and a different expiration will show up. I can change it to the 31st, and that one will show up. So now we look at this one, the front month, and the puts are on the right side, right? So this SPY tells us that at the time of this, it's trading at 203.4. And roughly that's 203.5 is the closest strike. These are the strike prices. And this is where each of the options are being traded at. So this morning when I sent out the put alert, I bought the December 24th expiration, so that you just switch it over here. And then you look down here on the put side, I bought the 203.5 strike. So that's here. Alright, so that's 203.5. That's this one. And notice it's 2.17, 2.4. In the morning, when I bought this, it was 79 cents. So I think it was 78x79 bid ask. And so the bid is on the left side, the ask is on the right side. And when you buy it at the ask. So when the other guy is asking for, so if you were to buy it now, you'd have to buy it at like the midpoint between this. So you put in a number, something near the middle of this, and hope it fills. But at the time I bought this, it was 0.79, and so you could see it more than doubled. Now, how do you execute this? Well, you can click add to watch list. So if I click that, all right, now that adds it to my watch list. And then if I click that, it'll open up the chart, and then I'll have buy and sell signals, right? Buy and sell. Let me move it up a little bit. So you have buy and sell. So you can click the buy. Alright, so it asks me for my finger ID. This is all mobile. And so here we have it. And so what you would do is you would say, oh, I mean, right now the market's closed, so the bid-ask spread is pretty wide. But let's say it were like 2.17 times 2.20. Then what you would do here is you would type in 2.2, click done, and then you can also click preview, get a sense of what stats that has. But otherwise, you would basically click the submit button right here, and then hit the transmit order. Since this is not, the market's closed right now, it's not going to go through, but I can do it, and it's going to say buy blah blah blah, exceeds or whatever. So you just click yes, right? Click yes, and here would not be placed until the following day, which is the next day at 9:30 when the market opens. So you could just click do not show this message again. That's just telling you that it's not trading right now. So now you have the status. It's not, usually it'll say filled here, but right now it's just purple saying that it's not currently traded. If you want, you can cancel the order or you can modify the order. Up to you. In this case, I'll just cancel it and just say cancel. So that's how we actually execute the order. You can also go into portfolio if you wanted to see what your portfolio looks like, but I'm not going to go there for now. So right now we have the trade executed, and just going back to our home screen, that's basically how we do it. We go into this app, Interactive Brokers, put in your fingerprint ID, and then go into the watch list. You can do this, or you could just click add contract and then just specify SPY, go into the options strategy builder, and that will open up this screen, and then from there you can choose the correct expiration and the correct strike price. Calls are on the left side, puts are on the right side. Now you might also be wondering, when is a good time to buy puts? I do have to say that puts are statistically a very low probability trade. I'd say probably 15% of the time you should be doing puts, since most of the time if you buy them you actually lose money. But just to give you a heads up, basically today or yesterday was the Fed announcement, the first time they raised interest rates in many years. And you'll notice that the Fed announcement happened and there was a certain pattern. And according to that pattern, I did not think a 1-2 big three was going to happen to the upside. Instead, rather a C wave would finish overnight. And so my prediction was that market would turn over. And that's actually what happens. So just to illustrate what happens, we have the Fed announcement that happened here, and we had a 1, 2, 3, 4, 5, and it went a little bit higher by finishing this A, and then B, and then a big C wave all the way up at like 6 a.m. in the morning. And so when it started to give this pattern A, B, and then once it crossed, this red crossed quickly below this point, that's when I put in the trade, and that's when I sent out the alert. And so when I sent that alert, that's when the put was trading at 79 cents. And of course, in the close was around here, and after the close it fell even further. So right now the put's is well over $2. When do you buy puts? You buy puts when you believe the direction is going to go down quickly, meaning it's going to happen pretty much in today or sometime in the next week. Otherwise, if you think it's going to go down in the long term and you buy a put, you're going to lose money on decay. And so the real money to make in puts is when you bet, and right when you bet on it, it moves down quickly, and that's exactly what happened today. And just pulling up a quick put chart. This is a typical put chart. The strike price and where the stock is trading. Basically, if you think the stock is going to go further to the left, then your profits are going to go higher and higher. So basically today the stock went really, really far to the left, and so our profits went really, really high. So why did I choose to buy a put? Well, besides the probability that I thought it would drop really quick, really fast, I also bought puts because volatility was low. And volatility volatility is usually low when we experience a rally that goes straight up for a couple of days, which is what happens. And volatility generally goes down when that happens. And when volatility goes down, that means the value of the put goes down. So that means puts were relatively cheap on a historical basis. And just to demonstrate this, on finance.yahoo.com, if you type in VIX for volatility and you pull up the 1 year chart, you could see that this morning it was like, below, it was like below 18. But just a couple days ago it was at 24. And so that's already, as anything in the 15, 16 area is relatively low. And if I believe that volatility will increase, which I think it will, because if it goes down, volatility is going to, shoot up, then I should be buying puts. If I sold a call spread instead, well, I would be selling, call options that are relatively cheap already. And so, if the market were to go down, yeah, I can make money on the direction, but then like the volatility kind of goes against me. So it's like I wouldn't make as much. And so when you buy a put, if the direction goes down, you make money primarily because of the direction going down, and then two, because it's going down fast, and then three, you get that added oomph because volatility increases. And so all three factors move in your favor. And so when we see something like this and we predict something moving down quickly, then you want to buy puts. You don't, I did send an alert selling a call spread saying that, basically betting that it won't go above 207.5, which is basically when I saw this pattern, 1, 2, and then 1, 2, 3. Once it had this 3 down and had this 4 up, I knew that it would be staying below 207.5 for, at least a couple of days, assuming that there's no quick rally that goes up. And so I sold a call spread with a short strike at 207.5. But generally, if you want to maximize your profits in this kind of situation after a huge run up like this, you want to be buying puts. You don't want to be selling call spreads as much. I sold the call spread because it's a fairly high probability trade, whereas the put, it has to happen quick. Otherwise, if it just kind of stayed around this area without falling, I would have lost money just on time decay. And so when you see something like this, when you buy a put, you want the direction to go down first and foremost. I would say probably with 65 to 70% importance. It has to go down, and it has to go down quickly. And then you have this added little 20 to 30% cushion by having the time value, the volatility component increasing as it goes down. And so that's the reason why I bought puts, and why my secondary choice would be to sell call spreads. So there you have it. I went through on my iPhone how exactly to execute a put trade, and then also the rationale behind choosing a long put buy instead of selling a call spread. And so that's what I did here to maximize gains and to realize so far 1,000 out of 2,000 potential in profits.